Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest on the show, just head on over to missionmatters.com and click on Be Our Guest to apply. All right, so today I have Marcelo Avogadro on the line, and he's co-founder and CEO over at Fundamenta Capital. This episode is part of our iConnects New York series, where we bring you the best that attended and participate in iConnections Global Alts, which took place in New York recently. Marcelo, welcome to the show.
Hi, Adam. Thanks for having me.
All right, Marcel. So I definitely want to get into the work that you're doing over at Fundamenta Capital. But before we do that, iConnections New York Global Alts. Talk to me. How'd you get connected to the organization originally?
Oh, we've been here about iConnections for some time. I attended, not as a participant, but I knew about their event in Miami a few years ago. So
Mm.
it was always in our radar. And finally, we decided to give it a shot. This is our first event. We know that their New York event is not the largest. The largest is Miami. We are hoping to attend that next year. But overall, it was a great experience. The good thing about it is that the meetings that you get, they are very, I would say, tailored. So you start at a good starting point because there's a fit between the allocator and yourself. They are talking to, and there is a natural interest to having that discussion. Very nice experience.
Awesome. Yeah, I'm a fan. I went to the Miami one the first time and I was hooked ever since. I was like, man, there's just the people you meet, the crowd, it's super, like you said, or it's efficient. You meet the right types of people pretty quickly. So great stuff there. Now I'll see you in Miami next time then. Let's see. So I want to get into Fundamenta Capital, but before we do, give me a little bit about your background. How'd you get started in this business?
My personal background actually is on the sell side. So I started at JP Morgan in New York. Then I moved to Deutsche Bank, based in Buenos Aires. I'm originally from Argentina, but then I moved to New York, spent several years there. Then I moved to Brazil, and my partners at Fundamenta, they come from the industry as well. Some from the sell side, many from the buy side. They've been running risk at different hedge funds, based in London, based in Brazil. So I would say the best part of the business is definitely my partners. We started in 2017. Back then, we were all living in different places, and we decided to get together, move back to Argentina to launch Fundamenta, to allocate capital in the region for investors and for ourselves. Back then in 2017, Argentina was it was hot for the markets. It looked like a good time to reallocate, with
Mhm.
also for personal reasons. And we have been running Fundamenta ever since 2017. In 2020, there was a regime change in Argentina. We decided to reallocate to Uruguay, but essentially the strategy and the business has been running since
Mm.
2017 without major changes.
Give us a little bit of an overview of the firm itself. So Fundamenta Capital.
Sure. When we launched Fundamenta, essentially the first question we asked ourselves is how would we invest our own money in the region? It seems pretty basic, but LATAM over the last 2 decades at least has been a source of a lot of volatility and not very attractive risk-adjusted returns. Usually people, when they launch a new firm or a new strategy, they can either be a niche player or they definitely need something different. Otherwise, why bother? There's a long history of why passive investments is the appropriate one for many type of investors. Now, that's not the story in many EM countries, generally speaking. We decided to launch Fundamenta with 5 founding partners. We are a mid-size or smaller firm, very niche. We run 2 strategies, equities and fixed income. And essentially, we try to do things different, and it has been working very nicely for both the equities and the fixed income strategy.
So what do you mean by do things different? Go a little bit further into the strategy and what you're looking at and where you're allocating.
Sure. So starting in first, our flagship fund is essentially an equities fund. And as I've been describing, LATAM, if you look at the past at least 2 decades, the regional index has been a source of a lot of noise and no compounding returns over time. So the first
Hmm.
question is, if you want to invest in LATAM, would you go for an index? So definitely no. What you get is a mixed bag of countries, some very good stories, some disasters, everything in the same bag. So first answer to our question is, you need a mandate in which you are country agnostic. That second question is, do you want to be long only? And for us, it's definitely not. There are a lot of opportunities on the short side. There is a very tiny community of active managers exploiting those opportunities in the region. So it's a good place to be as well. So we started with our equity fund in 2017, but our flagship fund also has a bucket that we invest in fixed income instruments. So we always had a team doing both equities and fixed income. But back then we were still living in the zero rate world. But in 2022, we exited that world. And when yield came back to the asset class, we decided to launch our dedicated EM credit strategy. So in 2023, we launched the EM credit fund. It has been returning, compounding 13% net for investors since then, with a very low volatility profile. We think there are good reasons that can be maintained going forward. It's a very nice setup. And we like to challenge conventional wisdoms in many ways. Because when people think about conventional knowledge, is that it is a more risky part of the credit spectrum.
For sure. Most people would say that about emerging markets, depending.
Yeah. And there are reasons for that. But the first thing we like to question is look at the fiscal trajectories in the world. So when you look at DM fiscal trajectories, what you get is you see that in the US, in Europe, in Japan, especially after COVID, the fiscal trajectory has been on a downward path at an accelerating pace. So you look at demographics, you look at pension systems, you look at healthcare systems, and they all paint a bleak picture. There's very little political room to do something about it. Deficits are looking a chronic issue. The stocks of debt keep increasing, and debt service make fiscal consolidation unattainable in many cases. So far, the market has been willing to finance those, but I mean, market discipline can be, the bond vigilantes can come back at any time, and the picture is not looking great. However, go to emerging markets, and it's actually the only place in the world where you can find fiscal discipline, which is probably the scarcest attribute in credit markets today. Why is that? Because EM has continued to play by market's rule over time. They never had the benefit of irresponsibility without getting market punishment. The market has continued to impose discipline, tighter covenants, healthy underwriting standards. So here comes the first counterintuitive part. If I show you a chart with the credit metrics of developed versus emerging countries, the unaware investor would guess them in reverse, think that the M is the M or vice versa. So that's
why do you think that is, by the way? When you say that, and just to go a little bit deeper to that concept, because I've had this discussion before, why do you think that is? So the credit standards, other things like that, maybe they were a little bit more liberal with the standards in the U.S. or otherwise, and versus in Latin America or Latam, they weren't? Is that kind of the key? Who they were extending credit to? It could only be to the highest, most credit worthy? I'm always curious, like, why is that?
It's interesting to think about the sequence, because historically speaking, when you bought DM, you got the full package. So you got the rule of law, you got the depth in the market, you also got, I wouldn't say more fiscal discipline, but at least similar ratios of credit metrics. Over time, and again, especially after COVID, those have deteriorated significantly. And the market has been willing to finance those, and central banks have got more creative over time. The experiments of central banks' balance sheet after 2008.
That's a good way to say it. I like how you said the experiments. Go ahead, Marcelo.
Well,
yes, please.
Exactly. So I'm not going to go into a macro discussion where
I understand.
some of the monetary Kool-Aid that people have been drinking over.
That other region didn't necessarily have the benefit of that, right? Is that what it boils down to? So there's, okay, go ahead, continue, please.
No, I was going to say, in the meantime, EM has continued to be treated as EM. And
that's such an interesting thought. When you say it, it makes sense, but go ahead.
Yeah. So then you can look at it on the two sides. You have the investor side and the issuer side, right? So let's look at both sides of the equation. First, from the issuer side, right? The issuer side, what happens is when you were in the QE era, a lot of the EM universe suddenly got market access at very low rates. And when you roll your debt at 2, 3, 4, 5%, and remember, in those days, a lot of the DM world was yielding zero or negative, right? So for a lot of emerging economies and corporate issuers, it was sustainable to issue debt, roll your debt, and that gave market access to a lot of issuers. And that has, I would say, exploded the AUM for the asset class, right? So if you look at the investor side, EM was a place in where investors look for yield pickup. You would get zero returns on your DM credit spectrum. You would go to EM to look for yield pickup, duration extension. You could leverage your portfolio. So suddenly the EM credit spectrum exploded in AUM and gave rise to many of these huge mandates where they are mostly passive. They mostly run money in the same way. They are mostly benchmark driven. But now you fast forward to the new world where QE is gone and these issuers now have to roll their debt 200, 300, 400 basis points what it used to be, and suddenly your fiscal situations get stretched, or suddenly your corporate models get stretched. So you need to hit F9 in your Excel, and guess what? There are going to be some winners, there are going to be some losers. Volatility is back in the market. And those mandates that were designed to pretty much buy everything in a world with very low volatility, in a world where you have the Fed put, is gone. So the numbers of default exploded in the last 3 years compared to the previous 20. And the industry is not designed to navigate that scenario. You cannot run your strategy in the same way, right? And especially when you think about credit, the asymmetry is not the same as in equities, where you can let your winners run and they will take care of the losers. Here it's pretty much the opposite, because you buy a bond with a predetermined coupons and your principal, but on your downside, it can get nasty very rapidly. So I would say the industry is not here for this new world. So first of all, EM as a place to find these opportunities has never been better compared to the M. That's number one. But number two, you need to think your mandate in a different way, run it in the same way. So that's where we come in, essentially. We don't run a benchmark-driven mandate. We don't own, as pretty much everybody else, like 100 names in our portfolio. We run like 20, 25 names, very deeply researched. We know our stories. We can avoid the losers by design. And we find for these stories that are actually, we look for them not on a static way. We look at it on a forward-looking basis. And that is the only way you can generate this type of returns with this type of vol profile. So when you look at a sovereign country, conventional wisdom is credit spreads are tight from a historical perspective, or this triple B credit is yielding, 20, 30 basis point cheap to the benchmark. We couldn't care less. We think most of those metrics are backward looking. We think that we're looking for stories on a dynamic basis. So on the sovereign side, we're looking for conditions for a particular country to change their model of growth. If a country was growing at 1% and has the conditions to organically grow at 2 or 3% potential growth, then there is a story in which we dig deep. And if we're right, that story is going to evolve from wherever it is, single B, double B, to a much better place. So whether it was cheap or expensive from a rating type of view, for us, it's irrelevant. We are going to get the capital appreciation of that story evolving over time. And that could go on the short side as well. On the corporate stories, again, we have a very deep research bench looking for 250 names, corporates in the region. We know them inside out, and we look for the same thing. So that is the reason, if you look at our historical performance, equity-like returns, yes, 13% net for investors with a very low volatility profile, sub 3% realized volatility since inception. And that's
Marcelo.
like a third of the volatility of the index.
Yep. Marcelo, this has been great having you on today. I really enjoyed our conversation. I'm sure the audience got a lot from it as well. That being said, if somebody wants to follow up, they want to learn more about Fundamenta Capital, how do they do that?
Sure. So easiest way, our contact information is on our website. It's fundamentacapital.com, Fundamenta capital.com. It's not necessarily a fancy website. In an industry, marketing, especially websites, are not necessarily a fancy place to go, but it's a good starting point.
Fantastic. For everybody watching, just so you know, we'll definitely put some links in the show notes so that you can click on the link, head right on over, connect. Speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. You heard me correct. Each and every day, we're bringing you new content, new ideas, and hopefully new inspiration to help you along the way in your journey as well. So hit that subscribe or follow button. And Marcelo, thanks again for coming on the show.
Thanks, Adam, for having me.